Welcome to our new normal. These are the headlines we're most likely going to be seeing for the foreseeable future. So what does this mean for everybody? There's winners and there's losers, unfortunately, in this particular market. First, I have to give you some context because there have been drastic changes in the way my business has been in the last 45 days in particular, mostly because of what's happening in the States. So the two things, apparently we're going to be the 51st state, whatever that means, or potentially we're going to be, and then tariffs. Tariffs have had a massive impact on what's happening here, especially with buyer sentiment. In the past, I used to go on a number of listing appointments with downsizers, predominantly downsizers, on a weekly basis. And this was true from beginning of the year up until middle of February. And the middle of February is when Trump started escalating his talk or threats of tariffs, 51st state, and all the other nonsense. And that is where a lot of buyers became sidelined. Understandably so. If you're scared for losing your job, there's absolutely no way you're going to be thinking about buying a house. So who's impacted the most right now? The people looking to get top dollar for their house are usually downsizers. So this group of people right now are the ones that are experiencing the highest impact. They're electing to usually just keep their house, stay put for the time being, unless they actually have to sell. The people that are potentially going to win in this market are upsizers. So these are the people looking to go from a smaller house into a bigger house, because these bigger homes are now selling at a bigger discount than they were even a few months ago. And there's one more category of land arbitrage. So in simpler terms, if you're moving from a hot area to a not so hot area, there's also an opportunity for you. I generally don't like to get into the weeds of the TREB real estate report, but I think at this point we kind of have to, just to show you the variability between different areas and how they're performing. When you see headlines in the news about the market, record lows, record low sales, record low prices, that is general market dynamics, right? But not every area is performing the exact same way. And just like during COVID, we had the darlings of COVID like Hamilton, Whitby, which outperformed every single area. We have a similar situation now where we have the darlings of a quote unquote recession. I started following real estate back in 2008, 2009. That's when I was really starting to watch it. And I remember during the financial crisis, Leaside was the darling of the financial crisis. It was the one area I remember it wasn't budging price-wise. Prices held stable. Whereas down the street in East York, prices would drop maybe 5%, 10%, and the rest of the GTA experienced even higher drops. So what is the darling of what's happening right now? Before we get into that, let's talk about what we're looking at here. How long are properties staying on the market before they sell or terminate? The worst performing area right now is King City in York region, 70 days on market. Whereas you have Durham, for example, a place like Ajax right now, properties are on market for an average of 27 days, which is pretty good. So the difference here is pretty substantial. Obviously, if you're selling something in King, you're going to be sitting for a lot longer, possibly not sell. Whereas in Ajax, you're likely going to sell within a month. How does that translate in Toronto? So I'll tell you, in Toronto, I had a story. I just lived through this. So the darling of 2025, 2024 even is the East End, especially East York, Beaches, Riverdale, Leslieville. So this is EO1, EO2, EO3. As you will see, the days on market here is 21 to 28. Really good, less than a month. Things are moving and prices are holding relatively stable. What is the worst area in Toronto? Well, that would be Toronto W05. And I can tell you this because I just lived it. I had a listing in this area. And by the way, last month, the days on market was roughly 70 days. Now it's 53. So it has improved. But this was a very difficult sale. It was a slow area, slowest one in Toronto. And as you can see, you're sitting on the market for at least 2 months and possibly not selling. So this land arbitrage basically means if you live in this little square pocket, and I'm just using the East End as an example because for the last year or so, it's been performing really well. So right here, East York. If you're going from East York and you're moving to Scarborough, if you're going from East York and moving to Stouffville, for example, where the days on market is double that of East York, right now, you're actually going to probably do relatively well because you're going to sell and you're going to get, in line with market. Whereas the property you're going to buy in a different area that's slower, you're going to pay below market there. So there's that arbitrage where even though the market is down overall, if you're coming from a hot area and going to a cooler area, that is the opportunity for you. The other opportunity, like I said before, is for people who are upsizing. But with that comes a little bit of risk because upsizing, usually in my mind, I'm picturing a younger family, and the risk there, especially just talking to my own clients, is obviously people are scared of job losses. You're highly leveraged. You're buying a new house, a bigger mortgage. If your job is not ironclad, you're going to have some hesitation, and rightfully so. You don't want to be taking on this big risk, especially with the uncertainty and especially with what's happening in the markets right now, whether it's the stock market, the real estate market. It's a tough time. But if your job is safe and secure, this is probably a pretty good time. One, there's a lot of inventory and you can really negotiate with sellers. Let's talk about GTA seasonal prices. So as you guys know, I always look at the trend line. Typically by this time of the year, we should be up roughly 8% in terms of median price since the December of the prior year. So in the last 4 months, we should have seen an 8% increase based on seasonal norms. And this is based on 20 years worth of seasonal norms. Now, early on in the year, in January, when I released the first video, we already knew we're way behind. So we're actually lower than the prior December. So we're starting kind of in debt. We're in the hole. And then in February, we had a very small increase. We're still not even at the December pricing. And now we just came through. We're a little bit higher. I don't think we're going to get much higher in the way of pricing, especially as more inventory is coming online right now. And we'll get to that in a little bit. However, the interesting thing is we're still following seasonal trends. So what likely is going to happen this year, we're going to probably plateau somewhere in here. And then it's going to be just another slow summer. And then I don't know if we're going to have a fall market. We haven't had a fall market for the last 3 years. Will this year be different? I don't know. At this point, it's just going to depend on the news cycle and what happens with the United States and how much more carnage is going to happen from their policies and the way they're treating their allies and everybody else. On the new listings, so the red line right here, so we've had above seasonal norm in terms of new listings because the people that didn't sell last year are piling on for the people selling this year. It's all getting combined, so it's a cumulative impact or effect that's happening. So new listings are new listings, okay? So this is not where I'm overly concerned because they're not substantially higher than we typically see. However, this part right here, this is the liquidity metric, or this is effectively how many properties are actually selling. Even in 2008, 2009, when the market or the economy was tough, our sales were higher than where we currently are. So right now we have some of the worst absorption, the worst liquidity, meaning we're selling a lot less than we typically do, even in prior recessions. And this is what's giving me concern because sellers that need to sell may not be able to sell. And this is now the third year of this happening. So it's 3 years of below average sales. Ultimately, something's going to crack. And I don't know if it's going to be price. I don't know what it will be, right? But this to me is the biggest precursor. If this continues for another few months, I don't see how prices can sustain because people need liquidity at one point and things will have to sell. So that means the only other thing that's left is price drops. Lastly, active listings. So this one makes for a great headline. It doesn't give me that much cause for concern yet. So we're at 23,500 active listings. Typically we're at 15,000. Yes, on paper it looks bad. We already know most of this is condos. Condos are there's 3 times more condos up for sale than we typically see. Off the top of my head, I think generally you see about 2,000 condos active listings. I think in the downtown core now there's over 6,000. So that's what's driving this number up. So it makes everything look bad. But again, blame it on condos. The cause for concern is that at about 26,000 active listings, which is how bad it got during the financial crisis in 08, 09. Once we pass that, I think it's going to be an interesting time period. Again, it will really depend on the mix. If we start seeing a lot more detached and freehold properties build up as well, that's when I think the dam is going to open. We're going to have other issues. If you found this video useful, as always, please like the video, share it, and I'll see you in the next one.